If you have any questions or suggestions, you can put it in a chat box that's placed right here on the screen, on the right side of your screen. So if you have any queries, usually which I do get at the end of the webinar related to stocks or particular, answers that are uh, needed by an investor or trader, so you can click on that particular link and post your queries. So I think we are gonna start now, and let's begin this particular webinar. Yes, so my name is Lavlesh Sharma, and I welcome you all on today's webinar reviewing the year 2018 SGX and KLSE trend. Uh, This webinar, basically, very honest, you we thought of having a webinar starting with a calendar in next year 2019, but I insisted that we should have this particular webinar around Christmas so that we can at least share some insights and improve the learning curve, because to see a particular trend, that's what the webinar is about, reviewing the year. So it's like basically a hindsight that once you are over it, it's easy to comprehend the particular trend, while going forward when you talk about future trend, it becomes a bit difficult. So by reviewing the year 2018, I completely do not mean that what has happened, what is the perspective, why it happened. That would be not very smart to talk about, because that thing has already happened in the past. So what we are going to discuss today is that what are the key takeaways from 2018, and how this particular year has shaped for equities market, specifically from SGX and KLSE perspective. Both markets are down. I've been there in Singapore and KLSE back in September, I think first week, and I briefly remember on 3rd or 4th of September we had our presentation lined up with a number of clients over there. And in Singapore KLSE, I was very specific that the year or the particular time horizon is not good, because the kind of volatility expansion we have seen in 2018, especially in the start of the year, quarter one, and in last quarter, which we are seeing since September, October, somewhere between that. So our basic focus will be on how market is, and what can be taken out of this market as a trader, or what are the particular sectors. So our basic idea here to go through is that we will be talking about market. We'll see some kind of technical indicators that are over there, and try to gauge the breadth of the market. Then we will look at sectors which I have prepared just an hour ago. So they are updated till date as of today's market close. So we'll be looking at different sector, both SGX, KLSE, and then we'll move forward with your queries. By the end of it, I may try to give some stocks, but given the overall trend, being a midterm to positional trader, I tend not to exaggerate the stocks, because the risk reward and all the things need to be in the favor of a trader. So let's start. Um, these are some of the awards and accolades of the company, and I've just put down there so you can have a look at it, and understand that we have a very good client base in SGMY and other Asian countries like Hong Kong and Arab Emirates, and we cater to them. And these are some accolades that we have received, and these are some of our associations on the national and international level, which comes with a lot of experience at our end. So suddenly you see a chart and you would be understand or you would be looking at it, how come, what chart it is, and what is the relevance. See, since we are on a time clock which is going on, so I'll try to keep it very crisp and quick. um, so let's start with something as in so this is 2018 basically, and that's what the chart in fact some of my things which I have shared in the PPT are still over here, and so we'll start at SGX and why or how this particular index maybe is down, or is it in a downward move, or where it is going, or how the global markets are shaping. So to be very simple in terms, because I will not try to complicate it here, but the this particular slide which I have shared in my first, this is nothing. This is, if you can read this, this is Singapore's GDP that is advanced year on year, and I've taken just 2013 to 2018 because that's the data I basically need, and these are something very important. Apart from all the technicals, one can gauge apart from all the analysis, moving averages, charts. I think it is important to gauge what the breadth that is the market is saying, because honestly the trends in the market are basically a result of, say, economic indicators, macro events. So if I'm like any particular point of time, I would say that this particular trend over here developed, or this particular trend from 2003 developed. So these are something which were bounded and happened due to some major economic event that happened at this point of time. We don't care about the tops, and that is something which is not a trader or as an investor should be concerned. Even me as a particular trader, say considering your time horizon, maybe it's like 3 months, 6 months, or a year. So for me a top in the market is not important, because they often happen, but what important for us as a trader is to catch these economic events or these particular factors that happen into the market. So how would you try to relate it at this point of time is, firstly, let me get back to you to the presentation again, and you'll be able to understand now this. Let me remove all the drawing here. Right. So this is SG GDP advanced quarter and quarter, and this is 2014, and this is 2018. Now you look at the kind of contraction that was seen in this particular data over here and over here. Those are the 2 points where you need to be worried that what is the movement of the market or how the market is going to react to it. There is no significance at this particular point of time, because the breadth or the larger thing that is going to affect or have an impact of on a market is certainly the macro factors, something as in exports, non-oil exports, especially when we're talking about Singapore, or tourism, or say inflation data, or what is the cash reserves, all those things, institutional things that one is able to analyze, or GDP, things like that, industrial production for the matter of fact. So at this point of time, if you see, there was a basically contraction, and that's what we are able to look at in this. You look at this 2011, 2013, 2014, you look at this large consolidation that has happened into the market. So when we talk about what is going to happen, we certainly don't know, but something interesting that happened into the market was, we cannot catch the specific bottom, but you look at this 2017 quarter 2 and 2015 17, right. The start on the first two quarters were very crucial. So that was one particular economic event that happened at that point of time where the GDP year on year saw a very high growth, and it topped at around 11, and it suddenly dropped in back in Q4 2017. So to give you a perspective how that reflected onto the market is somewhere, let's check our charts and we look at right this. So this is 2016. Now let me get back to specifics. So that is particular horizon that we are looking at, and 2013, 2014 to 2018. And if you look at this point, 2016, so as I said while showing you this, that we need to catch these macroeconomic events. So you look at this, so that was a kind of a base building that you would say. Now we at quarter three, we won't know that what has actually happened over here, or we would be able to catch it. But yes, there were a good amount of warning, at least if not here that market is going to be hammered, at least here there was a warning that yes, the revival has been fast. I mean, almost if you look at it, it's just two quarter from Q3 16 to Q1 17, and that's what you can see. Just a sec. Into the market, Q3 of 2016 over here, and Q2 of 2017. So that is one thing that you can look into market, and the kind of movement from there. You look at this, that's 30% return. So we are not worrying to catch a market bottom or something like that, but we need to understand that major market movement are driven by big economic events, and those big economic events are needed to be seen. So what happened then? Suddenly, all this is good in a hindsight. Everyone can prove it because it has happened. So what happened is, let's get back to um this is something very layman why I'm showing you, because GDP data is available with everyone. You just have to go on to investing or something like that. This peaked out, okay, Q4 2017. You see this gradual drop over here, so it's like a curve shape that shows kind of flattening out and then going downward, and it is again in a downward momentum. So simple as that. That is 2018, and you look at this, it's a downward market. Well, this is to give us a relative benchmark or relative performance, something relative measures where you can measure macroeconomic event or big things like GDPs to the overall market. So that gives you a kind of a momentum that you can see onto the chart as well. So let me show another slide, and I think I would be able to uh, prove you something. Right. I think this is Singapore non-oil exports. Most of the exports of the Singapore, like 33%, are basically manufacturing machinery, equipment. Then we have gold, jewelry, then oil, especially mineral fuels, and technological equipments. Going forward, all these things sums up to be a major part of the export-oriented countries such as Singapore. So this is non-oil exports month on month, and you look at this. This is monthly data. So just a sec. Yes, now you can look at it. This is June 2016. This is June 2017, and the basic thing you would like to look at it as, and there is not much of if you say trend. So if you talk about non-oil exports month on month, we are seeing broader range for the market to be 10 to almost minus 10. So that is on the higher part, that is on the lower part. So uh, let's look at it in a perspective to so June 2016, September 2017, and June 2018. So all the tops were declining. So on the upside, the exports, which were usually at that kind of a pace back in 2017 or 2016 to compare with 2014, we have been seeing a decrease. While the exports do jump, but at minor level, negative levels of minus 10. So just a yeah, so if I talk about June 2000, September 2017, let's look at September 2017 and erase all tries. Right. So let me put a line over here. That is September 2017. Now June 2016, 2016. This is June, right? And last time it was June 2018. So that is June 2018. So the difference, if you like to see, and December 2014, let's mark it as well. This bigger bar you're seeing somewhere around March 2015. So let me get to the March 2015. Here you go. So you would be able to understand what is happening into the market. Now consider this as a particular point or a particular uh, chart where you are able to understand that one thing is for sure, that the non-oil exports tends to remain into a kind of a range. I haven't taken that kind of a data where it can be a long term, like historically from 1985, 1990s, but they are into a kind of a symmetry where it goes down minus 10, we see an upward shift when it goes up, while most of the time it is oscillating between like 6 or say minus 4. So what the thing here is that extreme values do represent something into the market. So like if I'm talking about not to talk about 2018, because it has been a bear market for all the world global indices, but let's see what this bar had an impact. So suddenly when in March 2015 it jumped up and came down, you look at this March 2015, sorry, it jumped up, and as soon as this particular data dropped and we see again got back into consolidation, so does the market, and post 2015 we have seen a good amount of drop. And if I'm not wrong, that is when there was uh, shock related to the Chinese market, when most of the gains were out and there was $1 trillion something collapse due to equities. I think that is one point of time we can remember in the history. So this is that, and how would June 2016? Certainly something very low on the export side. You look at this June 2016, then while it was oscillating, we have had a fantastic bullish run into the market. As soon as this particular point, June 2018 came, yes, it was over here. That was one of the bearish moves. So these things do have an impact. The point is that these things create a big economic trend into the market. They have an impact on the flow of the money, because nobody would put a lot of money into the market. See, money moves the market. So if I'm talking about when to invest, so sorry. So certainly nobody would want to invest at the peak. So somewhere around the bottoms, or when there is a good amount of consolidations and we are seeing some of the economic expansion, that is at what can be reflected into the chart. So that this is what is overall here. Now let's talk about technical, that why we would believe that market is in a downtrend. And let's be very specific. There is no hope for now, because most of the global financial markets are down. Most of the US and European and Asian indices are down, and that is what one can see. Now, how does Singapore is related to that? Let me just see if I can give you a yes. You need to look at this particular image that I have cropped it because I had multiple workspace open. So I hope everyone is able to look at it and understand what I'm trying to say over here. So I'll point out something very important in this, and I'm getting queries, but you can put it on the chat box. All right. So this is STI over here. This is SPX, and this is HSI Singapore, Hang Seng against Singapore against S&P 500. So that's like a mix of Asian and Western market, and both are all of them are benchmark indices. For example, if I want to look at Asian markets in a perspective, I would definitely look at STI. Why I would like to establish this particular fact? Mm, just a sec. Let me see if it is the yes. So this is STI, Singapore Straits Times Index, SPX, and HSI. By default, you, if anyone is from Malaysian market, you must understand that when we are talking about STI and HSI, we are, I particularly, if not you, I particularly take into account not just my own Indian market, but KLSE as well, or Nikkei as well, or other market. It can be like Taiwan, or South Korea, or Thailand, Indonesia. So if you look at this, so all the markets bottom at around 2008, 2009. That is not a new story, something, but there is a specific decoupling if you look at it. So uh, you look at this. This is 2018. For your information, this is 2018, and why it is important is that there is a kind of a lag effect. There is a kind of a leading effect that you'll be able to see. The scale on the right is for SGD, HKD. Orange is STI, and this is HSI, and of course the purple one is SPX. So what I'm trying to pull it out here is that you see this particular top. Now this is not something important because all the markets made a top, and so yes, we saw a decline, and then uh, let me choose a different color so you'll be able to understand. Let me pick gray. Yes. Oh, just yes. So let me erase all right. Yes. So there was a top in all the three indices here. So we have had a good amount of synchronicity between all the markets, and then there was a top over here in HSI and STI, both the orange and the light green one. So they came down, and it was a significant percent, because 3600 to 3200. So it's like almost 400 pounds. That's a 10% correction. And HSI from 31,000 ish levels to 27,000 something, that is a 4,000. So it's like a 10% slide over there. So the synchronicity between the Asian markets was very much good. And of course, it has to be because one of the biggest exporters for Singapore is China. Most of the things we produce and we export is going to China, and that was the start of the trade war. So of course, US was benefiting. So this there was a major decoupling between the US markets and Asian markets. Usually, what happens? This is where people are trapped. Now, many would come to you and tell you that SPX is going higher and you should be investing. You look at your market, it is down 10%. You look at Western markets, it's up almost from say 3,400 to 3,800. So probably at this point of time, you think your market is 10% down. So it's an opportunity because the Western market is up from previous swing almost say 10, 11%. So it's a kind of a trap. It's not something as an opportunity or a lost opportunity where you can enter again, because that's it. The phenomena is called as a decoupling. And when money moves the market, so when the Asian markets were down, I should have known that yes, the money which was into the Asian market is getting out, and where it is going, it was going into SPX for the time being. Now you would say that yes, everyone knows that because it was the trade war. Of course, it's as simple as that there was a trade war. But how would we know that it's a something? So this happened over here, that there was a major decoupling. Now you look at this and we'll be able to understand this is somewhere between 2018 around March or June, right? So if this particular thing happened when market was almost at 3,200, so let me see if I can put it over this place. Yes, around June. So you would be able to understand that this point of time when global markets were up, S, SGX or STI was basically down. Now let me give you another perspective into it. How would you be able to understand this? That there is nothing to much to comprehend in this chart. You would yourself get the idea what I'm trying to say. That if I am able to understand this market, for us, the point of support remains only one. That is 2550 to 2600. There are intermediary supports in this market, and these are the bounds. So it's as simple as that. Given all the analysis that we have done, we have looked at GDP, we have looked at oil exports, we have looked at SPX, HSI, how they are behaving and how our market is related with HSI, while SPX continued to rise. But that too, if you notice, this particular market came down. Now, while we were already down 10%, now another 10%, that is almost 20%. HSI, SPX is now almost also down, say 600 points or 500 odd points. So that is almost 15%. So the point to look at here is that when you're looking at markets in that, just a sec. Yes. So perspective, you keep simply look at it where you need to enter and where you need to get out, and that is what I particularly shared with everyone. If anyone of us here belong to that particular presentation where we shared, so we were somewhere around over here, and it was September 2000. Right. somewhere here. So most of the people, while looking at Western markets, they thought that we are away from another top and we should be moving forward. That's how market reacted, and we had a very fruitful discussion that it's in a downtrend. So yes, at this point of time, we are in a bearish momentum. There is no doubt about it. There is no uh, question about it, because that's the broader range for your market has been since 2010. So something which has happened for 2008 to 2018, that your market has been in a downward momentum or a sideways momentum. For now it's downward, so you know when to get out of the market or when you need to enter into the market. So currently at 3046, if you are asked to invest into the market, I believe that there are much better opportunities that you may get. You certainly cannot expect that this is the final point, but history says that around 25 2600 markets are very good, and once we go below this point of support, that is 2950 54, which has been a support in the past, you know where it has to go, and the kind of velocity when this support is broken. Let me just if, show you how this works. Look at this, there was a support over here, so we have seen a good upward move, but that was overall bullish move in all the world market. But when this support is say broken, you look at this, how fast, almost 1 2 3 4 5 6 7 10 weeks, 2.5 months, and it fell from 3000 to 2500. That's almost 20% correction. This held on to here. There was a clear resistance, and now this is again becoming as a point of inflection where the trend may change. So when I say Singapore, and when I think about 2950, uh, below that I am bearish. There is no question, because usually that has been the range. Look at this, when it was broken, it played around this, and then again there was a bearish move. That was one significant support, and it acted well. But for now, over here, why it acted? Because global markets were largely up. You looked at China, which was going at around 8%, 9% growth, 7.5, 8 to 9, that kind of a range growth. So of course, when our country is one of the biggest exporter to China, so that was something we understand. But overall here, 2011 it was broken, and this is 2018. The global markets are very much down. There is no question about it. And just a sec, I think my audio is. Yes, I hope it is clear now. Yes, I think there wasn't any error on my side. It was maybe your microphone or something. So yes, so below 2950, I think the market is going to go down. This is a classic bearish market, and to give you another look at it, why it's a classic bear market. Uh, Let me show you a cyclic perspective. I have shared the same with everyone. Uh, Now and then it's something visible on the chart, so there is. Sorry. So whenever the long bottoms are made, or correction is seen into the market, and everyone is trying to jump into that kind of uh, levels where you need to have. So that's a long-term moving average, and I've applied it on daily chart, and let's put it as a 50 days MA, and another example of simple moving average, and we'll make it a 200 days. Yes. So this is a weekly chart, and if you are able to understand that there is a kind of very strong support and resistances that has been made on the chart. So whenever there is usually in this technical analysis, it's called a golden cross or death cross or crossover of 50 days MA to 100 days MA, and how it plays out is another story, because there is a lag to it, and a very big lag. So by the time you are able to understand what the signal is, the trading scenario has already changed. So over here we have had a positive cross that lasted for almost, say, uh, 7 8 years, since 2001 2002. So uh, over here prices were up, then there was a positive cross of 50 and 200 days, and so the market went up. Then there was a death cross, but by the time it happened, we were largely at bottom. So yes, there was a lag into this. Then again, when we have had a positive cross, you look at this market jumped up, and we again were off the bottoms, and they went up. There was a cross over here, it was right at the bottom, so we were not getting signal. And again, so the point here is the convergence of these two moving averages is very, very late, and it is not yet seen. But if you look at the daily chart, it can be seen that right. So considering your short-term perspective, you talk about 1 or 2 years or so, there was a clear death cross over here, and there was a positive cross over here. So this all phenomena lasted for almost 2.5 years. Again, we have seen a positive cross from quarter T3 2016 to quarter 2 2018. Again, 2 years. So the last correction lasted almost for 1.5 year, Q3 15 to Q3 16, 2 years. And we have just seen this. Now I don't believe that it has to be 2 years or 1.5 years. I'm not giving you exact numbers, but yes, you need to be aware of this particular thing, that there is a bearish trend, since market is below its long-term moving averages, and mean is one of the best prediction the future of future that can be done. Now coming on to other important point, let's just put KLSE as well, and this is a bar chart, and yes, so that's a KLSE chart, and it goes way back to 1983 for me. Uh, Again, same, it's the same thing that we have been discussing in SGX, that there are two broader ranges that both market respects for last few years. So for KLSE, it has been like 1900 to 1522, until unless there is some significant change in the or economics of this country. So 1600 is somewhat much better support for KLSE. So that's what you are able to see this bounce particularly here. So yes, for a short term, you can say that we may see some kind of a relief rally, because that's the area of demand that is coming in, and every time market hits this, uh, yes, this level, we do see a point where there is a pullback that takes this market on a higher trajectory. So this point, we are seeing this support to have that kind of an importance, where we may see some kind of support that can come in, and yes, there can be a bounce back. So to give you an overall range that how much it should be, so the usual momentum comes back to 1720, 1730 level. Once that is taken out, that may change the whole story for KLSE. But for now, we don't believe that it's a long-term upward momentum that can be seen from this bottom. But yes, maybe we may be going into a sideways consolidation. That is for KLSE. So let's come on to the most important aspect which I wanted to share with everyone. Let's start with SGX, and so this is FTSE ST, all the important sectors that are there on Singapore. Then we'll discuss the KLSE one, and very important thing for you to see this and understand why might be your portfolio is down, why might be your stock that you are uh, holding is down, why your portfolio is not working. So this thing I think is something which answers each and everything. This is the total return. So if you have invested for 2000 since 2017, 1st Jan 2017, only 2 years, okay, because if I go back, then your return would be of course positive. So and usually traders um are not that long enough to hold. They do, but keeping this perspective only for 2 years gives us something very realistic in terms of number, and something which is very close to present. So I've taken it from Q1 2017. You can look at it over here. January 2017 Q1. So this all starts from this, and that's a total return. So how much return you would have got if you invested in Jan 2017? We take that to zero, rebase it to zero, and see what are the returns. Very important for you to know that we don't want to know what is the winner for now. What is the stocks or what is the sector that you need to be away with? See, it's not about the return, it's about the risk that you are going to trade, because that is the sole reason you survive into the market. And that is one of the important thing that uh, you know describes how much your life as a trader or an investor would be. What would be your return? What would be your uh, gains if you are investing into the market? So you look at this from 2017, this orange line, this actually hurts me very much, because this is too volatile as a trader. I mean, a sudden drop from 4% to minus 30% up. Hope you are able to see this is 30, 20, 10, 5, 10, 20, 30, 35, 60. What is this orange line? That's almost down minus 55%. I'll zoom it for you, and look at this minus 55%. Who actually wants to bear that kind of a loss in a portfolio? The point here is, these are the losers you want to be away from. These are those stocks, those sectors that actually weighs down on your portfolio. Now, okay, haven't invested, say, let's just forget the market of 2017. Why just look at 2018, maybe since here, this is January. Let's see if all the markets are down, right? You ask a trader, yes, market is down. Even for me, it's a natural phenomena. The moment you buy a stock, it starts going down. Right? Happens to me as well. But you have several parameters as scaling or risk management, or if you are going to pyramid the position, or if you're going to scale in as the price moves up, or you're going to add when it goes down. What is your logic behind the investment? So let's take about January 2018. Who are the worst performers of this year? Minus 55%. That's basic materials index. Minus 31.26% over here. Minus 24.77. That's another loser that no one would want to invest in. This is blue, minus 14.3 FTSE small cap index. Then we have comparatively darker one, minus 11.87%. Then there is this pink, the large cap index. It is around 4.29%. Only winners over here are this. And second is green one, that is financial index, that is straight stance index 2. And then on the third we have the pink one, that is FTSE ST large and mid cap index. So when we talk about which sector you should be investing in, certainly, if not the worst, they are down almost from 35% to 16%. That means comparatively they are still positive, as opposed to minus 55, minus 24.77, that is consumer goods, that is minus 14.3 consumer services index, and this is 10.79%. This is healthcare index. So you should be aware from at least these sectors, because they are underperforming. Of course, one or two stocks may be outperforming, say IHH or some other healthcare stocks that you have bought. That might be a very good long-term bet, but we don't want to hold on to that because they're going down. And you look at this particular section, when they went from minus 5% to minus 55, minus 24, minus 10, minus 14%. They were already negative, while these things which were positive up 25% or say 20%, so they are down 9-11. So one thing you should able to understand from this is, when you're creating a long-term portfolio, you need to have the winners. Now, how would you say that? Now, let's forget this particular point, this particular side of the chart, and let's look at this particular chart. 2017. One of the best rallies that we have seen in Singapore is 2017. Everything was good. So, which sectors? You look at this green line that starts from here and suddenly tops at this blue and this purple. Now these other three, four, they were underperforming already, while I mean, straight stance index or financial services index or large or mid cap were performing. This particular area will tell you why to be aware that when all the markets were up, they were already down over here. You look at this healthcare, you look at this particular basic materials, and all them, while they were performing underperforming in 2017, they performed drastically down in 2018. So you now know which are the leaders into this market, and to name it, it's basically financials. And second is straits times as an index. That means if you are not understanding, or if you don't know which sector it is to invest, you can simply go out and buy the top 10 companies, top 10 weighted companies, say Jardine or DBS or something like that, and hold on to them, but for a given amount of time. And third is large and mid cap. So of course, all the things that are going to perform are large and mid. So you don't have that kind of a capital and you want to invest into the small cap index. But you look at this. This is ST small cap index and it is minus 14% down. It did perform till 2018 started, while it was only up mere 10%, while financial was up 35%, it was only up 10%. While on the top of this, the Straits Times index was up 25%. The small cap index was hanging around on the lower side. Now, let me just get to you another chart, and that is going to give you another perspective. And this is relative performance. So I have taken the base as a Straits Times index. I don't want to invest in, say, suppose STSE index, and I need to see which sectors did well. So this is again from 2017 Jan to December 18. Look at the relative performance till date. That means all the losses of 2018 are also adjusted and they are on percentage basis, right? I hope you understand that. So it all started with, say, amount of 100. So my return, if I invested in financials, I'm getting 111. So that's a 11% return on 100 Sing dollars or Malaysian ringgits invested, or US dollar invested in the market. Uh, what was the flattened out after 2018? This is why these are flattened out over here, because we have adjusted for 2018 loss as well. While this is to be clear, this is total return. So if you invested back in 2017 into each of these sectors, that is the return you would get, right? But if you invested only in the sectors based on and what are the performance as compared to Straits Times index, that is the baseline over here. What is the performance? FTSE ST financials has topped with 11.94%. Given the amount of correction already or deterioration already happened in the market. So again, whatever the worst, we need to be away from, or we need to at least consider risky basic materials. Then this one, that is consumer goods, uh, lightish blue, small cap, dark blue, that is consumer services, dark black, grayish, healthcare. Then there is minus 7% is okay. This is ST China, and minus 13 and minus 14 is over here. Consumer services and minus 13. If you look at healthcare, so only things that were relatively, even after the losses of 2018, had seen not much of a loss is FTSE mid cap. Then the red one, that is industrials, and of course industrial is something which you should be looking at in a kind of a investing way, because it is a very good index if provided you have a very decent amount of stocks. So I hope this particular relative comparison has made you or given you that thing which, as a trader, you should know that which sectors. Now let's go to KLSE, because I'm getting right. So this is KLSE, and first we'll see total returns. Right, this is total return. So suppose if you invested again in January 2017, I've highlighted over here all the sectors. So I hope it is visible to you. And let's look at which sectors did well and which sectors. This is see, you want to know who are the losers. We don't know who are the winners, right? It is the chart that is going to tell you who are the winners in this particular downfall or in this particular correction. And then you would be trying to gauge which are the losers. So, at least for now, when we have seen one of the best bullish rallies since the start of 2017 till 2017 end, sorry, and then a amount of correction. So, you need to know which sectors did well or which sectors did not do well. So this is Bursa Malaysia, plantation, KLCI as an index, construction, products and services, consumer products, financial services, industrial production, property index, and then Bursa Malaysia technology index. So which one performed well? Yes, that the one which has seen the most relative uh, growth as a sector, and this is financial services and technology are the sectors that needs to be uh, taken as something which has given a very good return. Then we have industrial production, which is 15% up. Then this green one, that is consumer products, of course, those one or the Nestle and all those stocks. So these are the sectors, and then the dark blue one, that is FTSE Bursa Malaysia Index itself. What are not to be considered? Look at this, minus 47%. Construction index, minus 22%. Property index, minus 12%. That is plantation index. So next time you are going to invest into the market, you must see who are the winners and the losers, and who are actually going to perform. So if suppose there is a bullish rally, you know which sector actually performs, and look at the kind of a growth. So from starting from zero, that's 100% growth, right? Then we have this blue line, and lately this orange industrial production also was up, and this particular financial services index was also up. So all these things were up while technology was, of course, all the way up. So you know which are the actually stocks that are going to be strong when the next bull market comes. All the other sectors, they depend a lot on the numbers. So when I said SGD or Singapore's GDP or Singapore exports, so when I'm talking about KLSE and I need to see, so I'm going to look at plantation index, then I'm going to look at property index, and last but not the least, construction index. So what is the construction, how is the construction going on, and what are the, what is the data that is coming out. So this is something you need to see, and this is total return. Suppose you invested back in 2017, there is no comparison between sectors and uh, index. So let's move to, yeah, this is a relative performance, and this baseline over here is taken as benchmark of Bursa Malaysia, that is the base, KLCI Kuala Lumpur Composite Index, and of course the kind of return you look at this, somewhere around 75%, none other than technology. Then we have our own financial services, 11% return in industrial production and services, and green one, that is consumer products and services. Again, so if I'm talking about, say, KLCI has given say 100% return, or say 10% return. So comparatively, if you want to invest into the market and look at which sector did well, into a bullish market, that is pre January 2018. So this was of course technology, then followed by financial services and consumer products and services and industrial production. But despite a bullish rally, if I'm hanging on to these sectors like plantation, uh, as a sector, or say property or construction, that is not going to give you a return. So when the market is okay, going up, and all the things are good, money is coming into the market, there's a fresh money, equity buying is seen. Sorry. Yes. So equity buying is seen, everyone is overly bullish, and the targets are coming higher. So in this point of time, these sectors, the underperforming one like construction, property, or say plantation, they do okayish. I mean, -5% to minus +5%. But when the things are not right, you look at -48%, -24%, -13%. So the idea is something you can note down or you can understand from this is, whenever the bull market comes, or whenever there is a bullish market coming, they do happen. They happen on the extreme fear or extreme panic. IT, financials, industrial production are the sectors you should be looking at to at least get some good return. If not in a bearish market since 2018, but if in 2017 the returns were at least 20%, 17%, or 11%, that was almost 75% because of the weightage of one or two stocks that performed well in KLSE. So this is something you can maybe understand, that whenever there is a bullish rally, bullish market, few sectors perform well. As in SGX, we understood that yes, financials or technology, or like I mean, these sectors do well, or tend to do well as in a bullish market, and bearish market, which sectors you need to obey with. So that was the basic idea behind this. And just a sec, let me raise all the drawing. So 2018, what has actually happened? The year started out with volatility. There is no doubt about it that January 31, I still remember January 30 and 31, markets opened after 3 4 days here, and the volatility actually was up 416 3% in first quarter. I mean, not January itself, but yes, that kind of a rise tells you something, that all the big money that was moving the market has seen a nervousness. So a jump of 416, 63% CBOE volatility is itself is one of the biggest indicator that the overall undertone or overall bullish sentiment has shaken, and we might not see a comfortable ride in a bullish zone. So that's what happened in Q1, and volatility index in Q4 again jumped 137%. So even if this particular point of time the volatility was coming down from Q1 and then again, but in Q4 we have seen it again up 137%, and till here it has been up to 125%. All these things like trade war, tariffs, they have created uh, global uncertainty in last few months around everywhere, and drop in crude lastly lately has also affected the overall demand scenario in global markets. So that is what has happened in 2018. There is no Santa rally for now. There can be some short-term swings. There can be some relief rally that can come in, and you may get caught in it. But for now, there is no Santa rally that is coming in, because just a sec. Overall markets are down. This is a classic. consolidated sideways to bearish market, and that kind of a drop, you see. So this is uh, KLSE, and this is, yes. So this below chart is of KLSE, and above chart is of SGX, and you will be able to see the, and let's just put let's compare it on same basis. So I'm gonna put it as 1000 bars. Okay, that is still too much to analyze because that's a lot of data that is coming in. So let's just put 2000. Yes, so there is a kind of a synchronicity between these two market, and to point it very honestly, that both markets see money flow uh, together. So both have a kind of um, pattern that do exist, where you can understand that how the money is coming into the market, because if we try to analyze and look at it in a way that this is 2011 Q4 and this is 2011 Q4, so let's just take this over here. Yes. So one thing you must understand, that something which reflects fastly, or something which see inflow of money fastly, is SGX, of course. Q4 2014. We look at this December Q4 2014, but the kind of up move in SGX, and then KLSE, and here in somewhere around September and October, November, December. That is 2015, and this is 2015. So while it was like flattish over here in 2016, D2, but the kind of momentum we have seen in SGX. So when the money is in into the market, the markets tend to go up. Now this is Q2 2018, and how beautifully you can look at it in February. There was a bottom in KLSE as well, but this was much sharper in SGX, and it came down straight away, while it sort of gave us a rounded top. So money was leaving the market, but slowly here, while it left the market in an accelerated manner. While it has been in a downtrend in 2018, you look at this, it is forming a curvish pattern. So pattern. So that was some kind of a decoupling, but yes, mostly bottoms into these markets are interrelated. They have a very good amount of correlation and good amount of synchronization when we talk about it. So that is it for now, and I hope the main idea you understood, which are the sectors that you need to be out of, which are the sectors you need to be in. The market is still broadly in a bearish trend, and there is larger supports and resistances that comes into play when we talk about both market, and they are still very far while it is near in case of KLSE, but in case of SGX we have 2950 as a point of inflection over here. So you must be able to understand that these markets they have a very broad range because they are trending in nature. This bullish cycle is a kind of a sub cycle. So if I'm saying that there are two cycles over here, so there are two phases that are placed over here, so we might get somewhere here. So just to give you an idea that what is this Lovelace trying to say, is there a kind of a bullish scenario that is going to come, there is a bullish market coming. See, I'm very vocal in that because when I was back in Singapore and Malaysia back in September, and people did ask me, there was, I still remember this gentleman, he clearly said that you are saying that the crash is coming. I said I'm not saying that crash is coming. I said uh, bullish market are outcome of excessive panic. So if we as a trader try to identify excessive panic, then I have given you that kind of a range where you see excessive panic or fear that has that will manifest itself into long-term bullish trend. So these markets have a range. There is a big cycle, and that comes into play. So if you want to see when it is going, so that is 2011, 2015, and 2015 to, so you're getting what I'm saying, that you have to be very vigilant and aware when you are pumping the money into the market. So it might not be December. I'm not sure if there is a kind of a bottom out process we are seeing, because we are still in a early sell-off phase in at least in Western markets. So at this point, given our overall relation with Western markets, 2012, sorry, 2019, January to February, you might need to be aware at that point of time. That is something very important. While at our end, we try to identify stocks that are based purely on this kind of analysis. But um, let me show you what is it that. So if I'm talking about say some stocks as in Singapore Airlines, it is in a sideways zone. I mean, there is no point in buying this stock. At least for now, it may see some kind of a pullback. But there are stocks that tend to decouple themselves. Like, for example, I was watching this chart. Look at this. That is a very short term move, but still, while it is overall bearish stock, there is no trend into it. That's a weekly chart, and since 2017 it has been down. There are points when this stock become or comes in an upward momentum. So that is one thing as a technical trader you would want to understand. So for example, in May, it was a good bet for, again, it gave an opportunity in uh, November or October. So when I talk about like Singapore, there are much bigger stocks that have manifested themselves into a bearish trend. But despite some bearishness, you can call it as an the kind of a screening process. Now you have see, look at this Wing Tie Holdings. Let me just, that's a weekly chart. So that's a daily chart, and there are points when these stocks do. So we don't know if we would be able to catch this, but we do get certain point where we believe that it's a kind of bottoming out phases, that is. So when your broader market is like down in this kind of formation, these stocks tend to decouple them away from the market. And for example, if I'm sharing Wing Tai Holdings, now this stock has a very strong resistance at almost 1.98 or 99, but above that we expect this to go to higher levels. So that is something not yes. So now you would be able to understand why. So these kind of bottoms, so they are like for a short term perspective. They happen one or two times in a year. For example, February, March, these things came. December, then again March, February, then again December. So this is February, March, and December, January, February. So after a consolidation, they tend to move up, and their bullish rally is also very good. So you must, after this consolidation, we expect Wingtire to at least perform well. I'm not giving any targets because it's actually based on a risk reward that need to be accustomed as per the capital. So I cannot say bluntly you can go out and buy Wingtire, but that's a perspective on how a stock can be seen. So for example, if I'm talking about that was Singapore. If I'm talking about, there was this one stock that came to me, Petronas gas, but it doesn't look that that AMB holdings, and so certainly not a stock that can be kept for a long term, but there are a point of time when these stocks, so it has breached its upward resistance line. We need only a confirmation for this stock above 4.43, and if that is supposed to happen, we may see a good upward move. But until unless it is below 4.43, we don't believe it to be a very good bet. So that is another way you can look at a stock, and using other technical analysis too. So I hope it has been a good knowledge sharing session. I've given you a few specific points, and those are very important for you to understand over here, that financials are both countries must have. Technology performed well in Malaysia, while in Singapore there were other indices that performed well. So your stock need to be from the winners club, and from the outperformers and not the losers and underperformance. So if a sector is not doing good in say a bullish market, it is going to be doing pathetic in a bearish market. If a sector has done good in a bullish market, it may correct, but the next time the bullish market is going to come, maybe next year, February or January, around that. So that is point of time when you need to identify which are the sectors that are doing well. Of course, you can contact us, reach us, and you can go through our website. And that is it for today. Uh, I hope it has been a great session. If you have any questions, though, you can put it out and related to stocks or any query. I'll be happy to help you guys, and share with you whatever I can on that particular stock. While we still have 2 3 minutes, I've expanded the actually time. I've taken it a bit long. Okay, you can reach us at info@epicresearch.sg, info@epicresearch.my, and I think this will be a very good weekend. And what I believe you guys must listen to when it comes to investing, uh, you have kind of an art, you have kind of sentiment that is attached to it. You want to be part of that particular herd that is going to get benefits. One thing you must remember as a trader or as an investor, that it is always darkest before the sun rises. So when I say that by the darkest, how would you relate it is to extreme fear and extreme panic, and before the sun rises. So whenever the market tries to bottom, it takes usually a month or two, because that is when the smart money comes into it. Now suddenly you don't want to see $1 billion money coming into market in a day, and you next day market is up. It is going to take a month. That is how the bottoming is done. And when I say it is darkest before the sunrise, we might need to see the darkest still next year. I think everyone can be hopeful. What I have shared is how you can identify which are the winners, which are the losers, and I have shared the sectors which tend to do or tend to outperform by 70% or 40% the overall market. But having a concentrated portfolio has its own demerits and has its own disadvantages. So you might need to have some kind of diversification coefficient correlation working out, some inferential statistics that may help you to create a better portfolio. Myself, Loveless Sharma, for Epic Research. Hope to meet everyone soon, and may God bless you with all the peace and prosperity. Have a Merry Christmas. Thank you so much. Stay happy.